In late 2015, a chip company was trading for less than the price of a cup of coffee. It was burning cash, carrying heavy debt, and getting outpaced on almost every front by two much larger rivals. Most of Wall Street had quietly written it off. 6 years later, that same stock had gained more than 3,000%. The company was AMD. And the real question isn't what happened to AMD after the fact. It's what AMD looked like in the moment before anyone knew that story was coming. Because right now, the US stock market is split in half. One half is trading at some of the highest valuations in its history. The other half, quietly, without much attention, is sitting near the cheapest levels it's seen in years. Somewhere inside that second half, there may be another AMD. And somewhere inside it, there are also stocks that look cheap and will simply stay cheap forever. This video is about how to tell the difference. Here's the picture investors are staring at in 2026. The S&P 500 is priced near historic highs. Its cyclically adjusted price-to-earnings ratio sitting close to 40 times earnings. Just 10 companies are responsible for roughly 83% of the index's gains this year, and yet sitting almost in plain sight, a different part of the market, small caps, value stocks, entire sectors like real estate and energy is priced at some of the most attractive levels in a decade. So why is one part of the market this expensive while another part is this cheap? What changed in the past year to trigger a rotation out of expensive growth stocks and into overlooked value? Which sectors are quietly loaded with bargains right now? And how do professional investors actually separate a real bargain from a stock that's cheap because it deserves to be? By the end of this video, you'll understand exactly how Wall Street hunts for cheap stocks with real upside, the formulas, the hidden filing deadlines, the calendar dates that move billions of dollars. And you'll see real companies currently caught in the middle of this debate. Let's start with the divide itself. Question 1. Why is the market split into two completely different worlds? For years, a small handful of mega-cap technology companies pulled the entire US market higher. Growth stocks dominated headlines and index returns, and the valuation gap between growth and value stretched to extreme levels. By early 2026, that gap had become impossible to ignore. Over the trailing 24 months into Q1 2026, the MSCI World Value Index delivered a cumulative return of plus 18.4% compared with plus 11.2% for the MSCI World Growth Index. In the first half of 2026 alone, the Russell 1000 Value Index returned plus 15.3%. beating the broader S&P 500's plus 7.43%. And small caps did even better. The Russell 2000 surged plus 21.28% over the same stretch. The numbers behind this split are stark. The S&P 500 Value Index trades at a forward PE of about 14.8 times earnings, well below the broader S&P 500's forward multiple of 19.90 times. Vanguard's own factor models, as of March 31, 2026, put broad US equities in the 99th percentile of historical valuation, about as expensive as the market gets. But the value factor sits at just the 30th percentile, and small caps sit at the 21st percentile, deeply discounted by historical standards. So capital is moving. The only question is, what's pushing it and what could stop it? Question 2. What pushed this rotation and what almost derailed it? The catalyst was interest rates. The Federal Reserve cut its benchmark rate in consecutive 25 basis point moves through late 2025, bringing the federal funds rate down to a range of 3.50% to 3.75%. That mattered enormously for smaller companies, which rely far more heavily on bank loans and floating rate debt than mega-cap giants do. Lower rates meant lower interest expense, better margins, and a real catalyst for small-cap outperformance. Then, on February 28, 2026, war broke out with Iran. Gas prices spiked 30% almost overnight. Inflation fears came roaring back, and the Federal Reserve, which economists had expected to keep cutting, was forced to pause and hold rates unchanged to start the year. This is the tension sitting underneath the entire 2026 cheap stock story, a rotation into small caps and value stocks that depends on lower rates, running directly into a geopolitical shock that's pushing rates the other way. And yet, even with that headwind, small caps and value stocks kept climbing in the first half of the year, which raises the next question. If rates aren't fully cooperating, what exactly makes these stocks worth buying right now? Question 3. What does cheap actually mean, and why does a low share price lie to you? Here's where most retail investors get it wrong. A cheap stock, in the popular sense, usually just means a stock trading under $5 or $10 a share. But that number, by itself, tells you almost nothing. A company can have a tiny share price and still be wildly overvalued if its share count has been diluted into oblivion, or if its market cap is high relative to earnings that are shrinking or negative. Professional investors call that nominal cheapness, and it's a trap waiting to happen. What they're actually hunting for is fundamental undervaluation, a stock trading well below its true intrinsic worth, regardless of the dollar figure on the price tag. A $150 stock can be deeply cheap if its real value is closer to $300. The goal is something value investors call the margin of safety. The gap between what you're paying and what the business is actually worth, big enough to protect you if you're wrong about something. So how do professionals actually calculate that gap? Question 4. What tools do professionals use to find the real bargains? There are 3 broad approaches. Comparable company analysis stacks a stock's PE, EV over EBITDA, and P over B ratios against its peers. Discounted cash flow analysis estimates a company's future free cash flow and discounts it back to today's dollars. And asset-backed valuation, used in distressed or asset-heavy situations, calculates a hard floor based on the value of what the company actually owns. From there, analysts run a deeper set of screens. The forward PE ratio, which looks at next year's expected earnings instead of last year's. The PEG ratio, where anything under 1.0 suggests a stock's growth isn't fully priced in. Price to book under 1.5, a classic signal in asset-heavy industries. EV/EBITDA for comparing companies with different debt loads. Free cash flow yield, which shows how much surplus cash a company is actually generating. And return on equity and return on invested capital, which reveal how efficiently management is turning capital into profit. But there's one toolkit that goes even deeper than all of these, one built nearly a century ago for situations where a company is so beaten down that you stop trusting its earnings altogether and start trusting only what it actually owns. Question 5. What did Benjamin Graham build to find stocks trading below their breakup value? Benjamin Graham, the father of value investing, created a set of formulas designed to strip a company down to its bones. His net current asset value, or NCAV, simply subtracts a company's total liabilities from its current assets. His quick NCAV per share divides that figure, after also subtracting preferred stock, by the number of shares outstanding. To guard against assets that might be worth less than they appear during distressed periods, Graham went a step further with the net working capital formula, applying haircuts to receivables and inventory. Cash counted in full, accounts receivable at 75%, inventory at just 50%, all minus total liabilities and preferred stock. Under Graham's classic rule, a stock becomes a serious bargain candidate when it trades at or below 2/3 of its NCAV per share. That's not a measure of growth potential. It's a measure of what's left if the company simply stopped operating tomorrow and sold everything off. These tools tell you what to look for on paper, but numbers alone don't capture everything. Sometimes the most important signal isn't in the balance sheet at all. It's in what the people running the company are doing with their own money. Question 6. Why does it matter when insiders buy their own stock? Executives sell shares for all kinds of reasons: taxes, diversification, personal expenses. But they typically buy shares on the open market for exactly one reason: they believe the stock is undervalued. Those purchases get reported on SEC Form 4, and corporate insiders are required to disclose them within 2 business days. That's a fast, almost real-time signal. High insider ownership, paired with open market buying, is one of the clearest tells that the people with the most information about a business think the market has it wrong. Institutional ownership tells a related story. Globally, roughly 60% of publicly traded shares sit with institutional investors. Large caps average 66% institutional ownership, but small caps average less than half, at 47%, with retail investors holding a notably higher 25% stake. When professional, value-oriented institutions accumulate a small cap stock, it means that name has survived serious due diligence, and that's a stabilizing signal in a part of the market that doesn't get much attention. But knowing the theory is one thing. Seeing it actually play out, a real company, written off by the market, clawing its way back from the edge, is something else entirely. And there's no better example than the company we opened this video with. Question 7. What did AMD's turnaround actually look like, step by step? Rewind to 2014 and 2015. AMD's share price had fallen below $2.00. The company was severely leveraged, burning cash, and losing on 2 fronts at once, outmatched by Intel in PCs and servers, and by Nvidia in graphics. By every conventional measure, this looked like a value trap, not a value opportunity. Then, in October 2014, Dr. Lisa Su was appointed CEO. She made 2 decisive moves. She refocused the company on high-performance processor design, and she shifted AMD to a fabless model, relying on Taiwan Semiconductor Manufacturing Company to handle production instead of AMD's own costly fabs. R&D dollars poured into a new modular architecture called Zen. That architecture became the foundation for 2 product lines: Ryzen for desktops and laptops, EPYC for servers, both of which delivered better cost to performance and energy efficiency than Intel's competing chips. The result: between 2016 and 2021, AMD's stock rose more than 3,000%. By 2026, the company had transformed into a high-margin semiconductor leader, posting Q1 2026 revenue of $10.3 billion, up 38% year-over-year, with data center revenue surging on the back of its Instinct MI350 and MI308 AI GPU lines. AMD wasn't an isolated case either. Decades earlier, a struggling, thinly traded penny stock called Hansen Natural was fighting for relevance against giant beverage conglomerates with its natural fruit juices and sodas. Management spotted a shift in consumer habits and launched something entirely different: Monster Energy. Instead of traditional TV and print ads, the company poured its marketing into extreme sports and alternative lifestyle sponsorships, and eventually struck a structural partnership with the Coca-Cola Company, gaining access to Coca-Cola's global distribution network. Hansen Natural became Monster Beverage Corporation. Over a 20-year horizon, it delivered some of the most extraordinary compounding returns in market history. 2 completely different industries, 2 completely different products, but the same underlying pattern: a company written off by the market, a clear catalyst, and disciplined execution that took years to fully play out. That raises an uncomfortable question, though. If these turnarounds are real, and they are, why doesn't everyone just buy every cheap, beaten-down stock and wait? Because there's a mechanism working against you that most investors never even know exists. Question 8. What's the hidden 45-day delay working against ordinary investors? Corporate insiders have to disclose their trades within 2 business days. Institutional asset managers overseeing more than $100 million get a 45-day grace period after each quarter ends before they have to file their 13F disclosures. That gap creates a real information lag. If a new institutional position shows up in a February 13F filing, the actual buying very likely happened back in December. By the time the public sees the filing, the smart money has already been accumulating for months. Active investors who understand this don't wait for the 13FI. They track order flow, custody clearing volume, and other real-time signals to catch institutional accumulation as it's happening, not months later. And that's not the only mechanical force moving billions of dollars on a predictable schedule. There's a second one written directly into the rulebook of one of the most important index families in the country. Question 9. How does a twice-a-year calendar event move the entire small-cap market? FTSE. Russell used to fully reconstitute its US indexes, including the Russell 1000 and Russell 2000 just once a year, every June. To reduce tracking lag during volatile periods, Russell shifted to a semi-annual schedule, full reconstitution in both June and December, with smaller adjustments in March and September. That single calendar change forces a staggering amount of capital to move. Over $10.6 trillion in assets is benchmarked to the Russell family of indexes. Twice a year, passive funds and ETFs tracking those indexes have to mechanically buy and sell to match the new index composition, creating volume spikes and price pressure that have nothing to do with a company's actual fundamentals. Active managers who know this watch for those windows specifically, because mechanical, fundamentals blind selling is exactly the kind of moment where a genuinely undervalued stock gets pushed even cheaper, temporarily. So, the formulas, the historical proof, the hidden mechanics, all of it points toward real opportunity sitting in the market right now. The next question is simple. Where, specifically, is it sitting? Question 10. Which sectors are loaded with cheap, high-potential stocks right now? 3 stand out in 2026. Healthcare real estate overall, is the most undervalued sector in the market, weighed down by high borrowing costs. Within it, healthcare REITs stand out, insulated by an aging population and the ongoing shift of medical care out of hospitals and into outpatient clinics, with attractive dividend yields attached. Financial services and lending networks. Regional banks and consumer finance trade cheaply due to tight credit and soft loan demand. But asset-light, technology-enabled lending marketplaces are seeing a real profitability recovery, scaling operating leverage without taking on the direct risk of loan default sitting on a bank's balance sheet. Energy. Despite generating enormous free cash flow, the sector remains structurally cheap. Persistently high oil prices, fueled by the same geopolitical tensions rattling the broader market, are letting disciplined exploration and production companies return serious capital to shareholders through dividends and buybacks. Inside those sectors, 4 specific companies are currently at the centre of the cheap stock debate. Question 11. What do the actual companies look like under the hood? Adient plc, ADNT, a global automotive seating supplier. Market cap of $1.57 billion. A trailing PE of 27.56 times looks expensive, but the forward PE drops to just 7.82 times. It trades at 0.11 times sales and 0.92 times book value. Adient is gaining ground in China, posting 10% sales growth there even as the broader Chinese auto industry contracted 10%, while securing onshoring wins in the Americas with Chevrolet and Volkswagen. But it's carrying roughly $2.4 billion in gross debt and about $190 million in annual interest expense from its 2016 spin-off from Johnson Controls, with razor-thin 2.95% operating margins. Q2 fiscal 2026 revenue hit $3.9 billion, up 7% year-over-year, with adjusted EPS of $0.52 beating estimates, even as the company posted a GAAP net loss of $288 million tied to a non-cash goodwill impairment in EMEA. LendingTree, a digital marketplace connecting consumers to over 100 lenders and insurers. Market cap of $562.6 million, forward PE of just 6.96 times. Its insurance segment surged 51% year-over-year to $221.9 million in revenue, with small business products up 49%. Its home segment, by contrast, remains pressured by high rates. Q1 2026 revenue grew 37% year-over-year to $327.3 million, and adjusted EBITDA surged 71% to its highest quarterly level in 6 years. Floor Corporation, FLR, a global engineering and construction firm. Market cap of $7.49 billion. The company is shifting toward lower-risk reimbursable contracts, now 82% of its total backlog, while holding exposure to the nuclear and small modular reactor pipeline through its stake in NuScale Power. Q1 2026 brought a rough GAAP miss, adjusted EPS of just $0.14 against an expected $0.62. But the company also monetized its NuScale stake and divested its China fabrication yard for over $2.5 billion, funding a $1.4 billion buyback designed to cut shares outstanding by 14% in 2026. Healthpeak Properties, DOC, a healthcare REIT owning outpatient medical and life science properties. Market cap of $15.45 billion, dividend yield around 5.6%, and according to an AFFO-based discounted cash flow estimate, trading at roughly a 38.7% discount to fair value. It was added to the Russell 2500 and Russell 2500 value indexes in June 2026, and management raised full-year guidance after standout Q1 results. 4 very different businesses, 4 very different risk profiles, but every one of them sits inside the same valuation gap we opened this video with. Which brings us to the most important question of all, because not every cheap stock on this list, or any list, is actually a bargain. Question 12. How do you tell a real bargain apart from a value trap? A value trap is a stock that looks cheap on paper, low PE, low PBI, but is actually priced correctly because the underlying business is quietly decaying. The danger is that the market often prices in structural decline before the historical financials fully show it. The distinction comes down to one question. Are the headwinds temporary or structural? A business facing a cyclical slowdown, a one-time legal charge, or a short-term industry contraction can still have real turnaround potential, provided it has a clear catalyst and sustainable cash flow. A business facing secular revenue decline, chronic margin compression, or product obsolescence is not undervalued. It's correctly valued on its way down. There are other risks layered on top of that core danger too. Many cheap stocks sit in cyclical industries, commodities, manufacturing, heavy construction, where buying near the top of a boom can be devastating once the cycle turns. Heavy debt loads turn ordinary slowdowns into bankruptcy risk. And small-cap cheap stocks often suffer from thin trading volume, wide bid-ask spreads, and exposure to delisting or regulatory shifts that larger, more liquid companies rarely face. This is exactly why the institutional voices covering this market in 2026 aren't simply saying buy cheap stocks. Goldman Sachs projects a 12% total return for the S&P 500 this year, while flagging that valuations are matching the peaks of 2021 doilies and pointing to a corporate search for value that favours cyclical, low-multiple stocks with strong free cash flow. Vanguard sees the value and small-cap factors as deeply discounted and positioned to outperform large-cap growth in the next phase of the cycle. J.P. Morgan expects a cyclical recovery to support financial value stocks specifically, on the back of stabilising net interest margins. And Morningstar singles out real estate, Ayrton and healthcare REITs in particular, as the most undervalued corner of the market, combining defensive cash flow with high yields. The consensus isn't everything cheap is a buy. It's the discount is real, but the filter has to be just as real. Conclusion. So, back to the question this video opened with, what does a stock look like in the moment before it becomes the next AMD? It looks, on the surface, a lot like a stock that's about to go to zero, beaten down, ignored, trading at a fraction of what it once was. The difference between the two outcomes was never visible in the share price alone. It was in the balance sheet underneath it, the catalyst building inside the business, and the discipline of the people running it. Right now, in 2026, the US market is offering one of the widest gaps between expensive and cheap that it's shown in years. A nearly 40 times CAPE ratio at the top, sitting alongside a value factor at the 30th percentile and a small cap factor at the 21st. Somewhere inside that gap are companies running the exact same playbook AMD and Monster Beverage once did. And somewhere inside it are companies that will simply stay cheap, for good reason, forever. The tools to tell them apart aren't secret. They're the ones laid out in this video: fundamental value over nominal price, Graham's liquidation formulas for the deepest bargains, insider buying as a real-time signal, the institutional reporting lag as a hidden edge, and the Russell reconstitution calendar as a structural catalyst, all filtered always through the question of whether a company's problems are temporary or permanent. If this kind of market breakdown is useful to you, subscribe for more deep dives into how professional investors actually find value most people overlook. And let me know in the comments which of these 4 companies you'd want a full breakdown on next.